Good afternoon, ladies and gentlemen. It is November 18th, 2021, and absolutely crazy to think that it is a week away from Thanksgiving. My daughter recently turned 1, so certainly the last year has gone by so fast, and it's certainly been a crazy year, both economically, politically, in the stock market. And we could not be more grateful during this season of thanks for all of our clients and all of our advisors for your loyalty, your perseverance, and of course, everything that we've learned from you over the last year. And as we get into Thanksgiving, we just want to wish everyone a very happy and safe Thanksgiving. And of course, if anyone has any questions or any needs throughout the next week or into the holiday season, into the end of the year and beyond, please feel free to reach out to our offices or your advisor, and we will be more than happy to help. So let's go ahead and get started. So for this week's market update, we're really going to focus on risk, and we're going to focus on where the economy is and how we can make money, but just as important, how we can avoid losing money. And when we think of a stock market at a new high, it can be very easy to say, oh, it's in a bubble, or it's going to come down and crash because it's at a 52-week high. And remember, the stock market, generally speaking, with the exception of 2020 and COVID, been making new highs for 10 years. So that rule would have precluded us from taking part in a lot of those gains. But within the stock market, there's a bunch of companies. And sometimes those companies can trade at very cheap levels, as we see in the energy sector right now, or can trade at incredibly expensive nosebleed and speculative levels, as we see in the EV sector right now. And so what we really want to do as we close out the year and go into the new year is to continue focusing on those uncrowded trades that are not just uncrowded for being uncrowded, but they also command attractive long-term growth rates. So the three big things that we're going to review this week are the economy. What's it looking like as we close out the year and get into 2022? Then we want to identify those specific areas of the market that do have some elevated risk right now, those areas that are quite speculative, nosebleed levels, where we want to avoid getting hurt. Lastly, and certainly not least, we want to assess stock market leadership. What's been leading the rally? What does it mean? And when we see this type of leadership, how do we want to position portfolios going forward? And lastly, of course, we want to have that oil sector review. It's the biggest weight in our portfolio, so it's important to do quite frequently. So in terms of the overall asset allocation, we often get the question of, do you like the stock market right now? Do you think stocks are going higher? And my answer, if you've ever spoken to me directly, always is, well, which stock are you talking about? The market's a collection of different stocks. But if we do take a step back and look at stocks, the other thing I always say is, well, where else can you put your money, right? And generally speaking, as investors, we can put our money into government bonds, corporate bonds, high yield bonds, cash, real estate. And here's the thing right now. With inflation at 6%, we look at all these other options, we technically, my compliance officer will always mention this, we can never say 100%, but we can almost, with a very high degree of confidence, say that you will voluntarily lose money by going into either government bonds, high yield bonds, corporate bonds, cash. Why? Because inflation is running hotter than what these asset classes are yielding right now. So when we're in an environment where all other options are bad and stocks look least bad, that means stocks look pretty good, right? Because stocks can still grow earnings 10% plus, while all these other sectors and asset classes are growing under the rate of inflation. Now, do we think inflation is going to stay at 6%? No, of course not. We actually think it's going to moderate into that 3 to 4% level, and we'll talk about the factors driving that later on in the presentation. But the important thing to remember is we basically fought a world war. It was called the pandemic. And after every major war, the US has exited that war with high levels of debt to GDP, which we can see in this light blue line here. And every single time it's been accompanied by negative real rates in terms of government debt. Why? Because the government inflates away its debt when it goes through big spikes of debt to GDP. We saw it during the US Civil War, World War I, World War II, and now we're seeing it after the pandemic. The bottom line is debt will lose you money. In other words, bonds will generate right now are generating a negative real rate of return. So we want to avoid that and help protect you from those types of losses and reposition you into quality businesses that can make more money during times of higher prices. Now, in terms of risk, really right now, the real risk we see is quite contained to pockets within the stock market. And when we look at investor flows into the NASDAQ, into the S&P 500, they're getting aggressive, but they're getting aggressive within EV. They're getting aggressive within technology. We know that 40% of the S&P is technology and communications. And so for us, it's not so much getting in or out of the S&P 500. It's about where within the S&P 500 during an early economic recovery can we find value? Can we find cheap prices so that when things do pull back, we're not as impacted by that and we can actually make money. So for us, we're staying cheap, energy, industrials, financials, and away from the center of the storm, technology, EV, et cetera. Now, the other thing, put call ratios do remain pretty low. So not a lot of people trying to short the market right now. So we always want to be cognizant of that. Now, one thing that has gotten people a little bit nervous is those COVID case counts in Europe and in the US have started to rise again, more so in Europe. But here's the good news. Unlike the summer of this year, unlike 2020 during both of those waves during that year, we're not seeing economic activity slow down. In fact, we pay attention to what we call the second derivative. What is that second derivative? The second derivative is following actual day-to-day activities. So when we look at flight departures, TSA throughput, air travel search interest, car rental search interest, hotel bookings, all these things are accelerating week over week, month over month. They're accelerating. And we see it in the economic surprise index indicator, whether it's in the US, China, or the Eurozone. Things are picking up relative to expectations. That's what you want to see. So we're not too concerned about COVID cases. We actually think no matter what happens right now, the economic ship is trudging through more cases of COVID, and we're transitioning from what we call a pandemic to an endemic. In other words, yes, there's cases out there, but largely speaking, people have been vaccinated. You're going to get some people that die, but overall, the death rate is low. Most people have been vaccinated, and we're now getting pretty low-cost treatments for people who do get it. So all of this is kind of geared around the fact that the economy is going to continue to reopen no matter really what happens at the end of the day. And we're seeing it in the way that stocks are behaving. Early cycle and cyclical stocks continue to outperform and lead the overall rally. We see that in the cyclicals relative to what we call recession-proof stocks. When we look at that relative performance, cyclicals continue to outperform. We now expect the 10-year yield to catch up, which is this red line, up to this blue line, which again becomes a self-fulfilling prophecy, which should be good for banks, energy, industrials, et cetera. So this is good. Early cycle stocks leading the charge is a vote of approval that the economy is healthy and in a very early stage of recovery. We see it in the manufacturing data, industrial activity spiking, capacity utilization spiking. These are signs of recovery, not pending recession. And then, of course, the inventories. We go into every store. We've experienced this. Stores are running out of stuff. Guess what? That's not a sign of recession. Yes, it can push prices higher and that hurts, but it's also a sign of very, very high consumer demand. And we've been saying this for weeks and months. Low inventories are the result of extremely high demand. The supply chain is not designed for the developed world to grow at 4 to 5%, but that's what's been happening. And the US consumer is spending like crazy. So when inventories are this low, it's very hard to get a recession because you don't have companies cutting back orders, which ripple throughout the supply chain. You're actually in the opposite. They're trying to gain supply. So you have a steady rate of growth as a result of that. And the stocks are backing that data. We see industrial stocks are breaking out to new highs. breadth is expanding. More and more industrial stocks are participating in the rally, and investor flows remain tepid. Until investor flows get into this 95th percentile, we don't have a whole lot to worry about as it relates to these early cycle leaders within the stock market. And then, of course, oil inventories are razor thin. So when we think of our structural call, both long-term and short-term within oil and energy stocks, we love where inventories are going. We love the overall day-to-day rhetoric. So a lot of people would say, oh my God, I'm bearish because they're going to release the strategic reserve. Go ahead, do it. Because guess what? That's you're going to give oil producers more leverage. At the end of the day, we're talking about that because oil demand is so robust and the industry has not been allowed to respond to rising demand because the administration in DC is anti-oil. This is a perfect setup for a long-term structural bull market. The US asked China, India, Japan, South Korea to all release oil. The US is desperate for oil. That's what that tells me. And of course, we see that. Tesla, you could buy Tesla stock, or you could buy all of these energy stocks for the exact same price. It's an incredible phenomenon in terms of what's going on in that EV bubble right now. Now, I would add, Tesla is definitely the real company within that bunch, but certainly a lot of speculation within EV right now. And when we talked about that peak inflation, what do? We look upstream. So when we look at dry bulk shipping rates, which is the chart on the left, collapsing. We look at container shipping rates from Shanghai to LA, coming down, not collapsing, but coming down quite a bit. All of these are second derivative leading indicators to what will ultimately feed into CPI, or that headline inflation number, in January, February, and March. That's our job, is to look at upstream what's going to impact the headline numbers 3 or 4 months from now. And so this is good, and it's good for stocks. And we talked about that sales are accelerating, right? We said, hey, inventories, and we've been saying this for months, are not a function of trying to gain access to supply. The supply chain is perfectly prepared for 2 to 3% growth. It's not prepared for 4 to 5% growth. And that's been the problem, has been that US consumers are spending so much money. And finally, we see that in the data. Look at these retail sales growth figures. They're incredible. This is growth that typically is tied to a country like China, not the US. And that is why we are so bullish going into the end of the year and into the 2022. So overall, as we head into Thanksgiving, we want to focus on the recovery. We want to ignore the noise, and please try to ignore some of this euphoria in the EV. I'm really concerned that people who are getting involved now could seriously lose a lot of money. So please try to avoid those areas. Invest in some boring companies. Invest in companies that are going to do very well if the economy continues to grow and reopen. Could be the travel sector, could be the energy sector. You pick your poison. But those areas that all your other friends are invested in, and your grandpa and grandma and mother and daughter and friends, if they're all invested, at some point you run out of buyers. So be very careful in those areas. So 3 bottom lines here: the recent rise in COVID cases, let's ignore that. Economic activity is rising despite of that. Number 2, early recovery sectors and stocks are leading the charge. That's a very healthy sign for stock market leadership. And number 3, again, that sentiment in technology and EV is very, very euphoric right now. So we want to be very careful in those areas. So thank you again to all of our clients, to all of our advisors, for all of your loyalty, your business, and most importantly, your friendship throughout 2021. Have an absolutely great, happy, and safe Thanksgiving. We are off next week, but we'll see you in 2 weeks. And again, happy Thanksgiving and have a great and fantastic weekend.